The August has ended and so will the ghost month. The last day will be on September 2. What's in store for the markets this month? Let's look into the charts. My name is Dan Slim and welcome to another episode of Monday Market Outlook. So, the PSEI was up 3.8% last August, closing the month at 6,897. The early dip on August was actually a 7.19% swing, and this went even as high as 9.66% at its peak. But are we in for a rough September? Back in August 2022, we saw how a positive August can precede a very sharp September correction, and generally we do see the next couple of bear months to be tough on the market. In the meantime, let's look at the PSEI charts. The index still having difficulty at the 7,000 zone. Remember, back in Feb to March, this was the zone of contention for the bulls and the bears until the bears finally won. But back then, if we expand this MACD here, look at the divergence, right? But this time around, we don't see that same divergence. So could this be the pullback that the markets need for a buy the dip opportunity for a surge back to 7,000, even 7,130? Now we are looking at the 6,800 or so for the next support. If this is the peak and this is the trough, a Fibonacci line here shows that the 0.38 Fib does correspond to these levels also. Zooming out into the longer term view, we can see this downtrend line and uptrend line forming a triangle here. Could this be the breakout of that long consolidation and a retest of this trend line support here, and a bounce off of that could just be the key to confirming this breakout? Last week, as expected, we consolidated along the 6,900 to 7,000 zone. If we go to the weekly charts, could this red candle mean that we still have a bit of correction to go before the market rebounds? Back to the daily charts, remember that 6,800 here was a previously strong support level which became resistance here, and now it's back to being support for the index. And we have confluence here, right? So you have your support level here, you have your 38 Fib, the trend line, and even the 20 EMA moving average. So watch out and be ready for a possible buy the dip opportunity to join this current market rally if it manages to hold this support. If the market will continue its rally, then we need these index heavyweights to lead the way. Let's look at some index movers. Let's start with conglomerates. AC and SM hitting their resistance levels. Investors taking profits off of that. Not a good week for the conglomerates. Let's see if AC can hold this level here, or could we see AC back into support at 583. SM, two big red candles worries me. Support one may not hold. Let's look into 850 if it breaks this one. Let's see first if 870 will hold. But then property stocks surging last week. Ali looks like it's headed towards 36. SMPH surging back to this resistance level with volume, looks like 3175 is within reach. Banking stocks back to a sell-off or a consolidation. BDO overstretched a bit, 38 Fib, but the 61.8 Fib looks more interesting at 143. BPI, a pullback into the 38 Fib. Let's see. The 20 EMA, 50 EMA looks better with the 61.8 Fib along those lines. Also, Metrobank breakout, could it retest the 72.15 support? Dividend X date on September 4. Let's see how Metrobank reacts to this news on Wednesday. Consumer stocks are on the rise. JFC surging to 260 as expected, almost into our first resistance zone. The next resistance zone would be at 269. We've seen investors taking profits off of resistance zones. Let's see what happens to JFC this week. Monde also consolidating along these lines. Wilcon finally breaking out here. Let's see if it can manage to retest its 200 EMA and break out of that. Could the worst be over for Wilcon? Even Keeper is doing very well, right? Telecom stocks taking a breather this week. 2150 again is the support level we're looking at. Even PLDT going back to the 50 EMA, buy into support at 1462, 1500 actually looks like a good level. So back to the PSEI charts, most of these index movers reacting to their resistance zones, so it does make sense for the market to pull back a bit more to get more buyers back into the market. And what's happening here really is the funds are just moving back and forth between different sectors. One week it's the banks, then another week it's properties, one week it's telecom, the next week it's consumer stocks. As the stocks hit their resistance levels, we do see a sell-off, and as these stocks hit their support levels, we see some buy the dip action happening. So let's see what happens this week, right? So last week we did a screener for cheap stocks and a couple of interesting names popped out. We have MEG and LTG here. They're actually trending upwards. They're above their moving average supports. MEG testing its resistance here at 193. If it breaks out of that, look at this volume here. If it breaks out of that, 209 could be your next level. LTG also doing quite well. There's a bit of a trend line resistance here. If it manages to break through 1022, we have 1058 and maybe even 1126. Now, I don't monitor MEG and LTG. They're not really the best stocks in terms of fundamentals. They're okay fundamentally, not very exciting, but they do have good technical setups. They're very cheap. They have good technical setups. We could see some interesting trade possibilities here if you are into that. So let's go to the global markets. US GDP was adjusted last week from 2.8% to 3% and was largely driven by consumer spending. Of course, this is good news as the American economy is 33% consumer spending. Also, Wall Street welcomed the update on the personal consumption expenditures index, which showed price increased in line with expectations. In July, core inflation, which strips out food and energy prices, rose 0.2% month-on-month as expected. The annual rate came in at 2.6%, matching June's level and undershooting the 2.7% forecast. But the further cooling of inflation could give the Fed leeway to be more aggressive with rate declines in the coming meetings, especially if the labor market shows a steep deterioration. Remember, last month's JOLT and employment's data shocked the markets. The Fed has become worried about a softening labor market, which all but sealed the decision for the Fed to start the easing cycle this September. The debate is now focused on whether the Fed will cut by 25 basis points or 50 basis points. And this week could be a pivotal week for that decision, as we again will see the JOLTs, ADP, and even the unemployment data. Now, these data points are usually reported at the start of each month. And meanwhile, back home here, we will have our manufacturing PMI data, inflation rate data, and also the unemployment rate will be announced, and we'll see how the local markets will react or will celebrate the news this week. So we haven't looked at this chart for a long time. The yield curve is now very close to an inversion. This is the 2-year and the 10-year yields. And a lot of economists believe that a recession is imminent once the yield curve finally uninverts or goes below 1%. But some has expressed concern that this indicator may already be broken. This time around, same with the SAM indicator. But eventually, we are still talking about a landing here, even if it's a soft landing. The effect of high interest rates for a very, very long time will still be felt with the economy. So a landing is still a landing. Something will still break in the economy, even if it's a soft landing. So let's go to the S&P 500 charts. The S&P 500 notched its 4th straight month of gains, look at that wick there. On a weekly basis, though, we can see this incredible comeback last August. And as we enter into September, let's go to the daily charts. We are encountering some heavy resistance here at the 5,650 level. The market continuing to consolidate along this area, ending last Friday with another short squeeze here. Now, if we go to the 2-hour charts, what do we see here? We see the consolidation happening here, and the indicators, the momentum indicators showing a divergence here, even becoming negative, right? So again, are we anticipating a gap fill eventually in the next few weeks? So far, going back to the daily charts, we've actually managed to pull back in time, as the consolidation here puts us back closer to the 20 AMA. And remember, the labor data will be coming in this week. If the labor data comes in worse than expected, then we could actually see the gap fill happening as soon as this week. If the labor data comes in better than expected, then we could probably see the markets try for another all-time high. Now, let's look at some September trends. We are seeing more volatility in the last 10 years for September. We get a slight dip at the start of the month, then a big rally followed by a steep correction towards the end of September. Even in the past 50 years, the tail end of September has been consistently rough for the markets. And going back to this data point here, the tail end of September does look like it's going to be where we may finally hit those key support levels for the S&P 500. So what's happening with the markets right now? The market's correcting a bit. If you were able to take profits last week, this should give you some buying opportunity to buy back into some stocks. In the meantime, let's see if the markets can hold these critical support levels. Most of the funds actually are still on a wait and see mode. Now remember, the BSP has just started the easing cycle. The Fed is starting its easing cycle. So we still don't know the effects of the rate cuts in the economy. So what's happening with the funds here is that they are moving back and forth between different sectors, speculating on which sector will benefit more from these rate cuts. This is why you're seeing funds go back and forth between banks, then properties, then conglomerates, then consumer stocks, and then telcos. So until we see some more indicators, this is probably what's going to happen to the markets. This could actually be a good buy the dip opportunity. So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.